When we look a little deeper at the relationship between the VC fund and the limited partners, this is what they'll see. The placement memorandum, which evidences the investment, they declare all these things we mentioned, like what's the objective of the fund, the duration of the fund. Then there are disclosures, because it's quite a legal document, because there's a lot of money involved, and those are complying with state and federal laws. Then there's the overview of the fund, executive summary, and the summary of terms. Summary of terms lay out the legal and financial rights of the various parties, and also the compensation. So this is an important aspect of the placement memorandum, is the compensation that will be paid to the VC firm for creating such wealth, we hope, for the limited partners. All right, so the mechanics. We mentioned that there is a commitment made on the part of an institutional investor. Well, when there's an investment that's about to be funded, at that point, the VC calls on the limiteds to put in their proportionate share of the amount for that investment in the entity, the venture. And the reason we do this is pretty clear if you think about the finance of it. If you're an institutional investor and you invest $100 million at day one, now it's sitting in cash in the venture capitalist's hands, but the clock is starting to tick. The institutional investor will measure the rate of return starting from that moment. Now let's set that aside for a moment. Let's say now we do the other way, how it's done now in VC firms. VC firm says, we will eventually call upon you for the $100 million. However, don't fund anything until we've actually identified and are about to fund an underlying investment in the portfolio. Now, the institutional investor doesn't have the clock start ticking yet. It only starts ticking when the money is moved, and it doesn't move in the entire block of $100 million. It moves only in the amount that they have of that investment. So that's how the VCs kind of manage the assets under their care, so that their rate of return is as much tied to the working of the actual portfolio as opposed to sitting there waiting for a suitable investment. Compensation is lucrative if the VC firm does well. And it's not so bad even if they don't do well. They just won't survive very long. So there's a term that we often see in politics, because it's an area under attack from many sides in the US population. It's called carried interest. Carried interest is the upside, if you will, the sharing of the profit if the VC does a very good job for managing the investment. So it's a proportion of the money that is earned in excess of what the investors put in. Very simply stated, if you're an investor, what you want is you want return of your investment and on your investment. So what we're saying is that the VC firm says, okay, Mr. or Ms. Investor, after I return all your money back to you, we're going to then split the excess so that it gives us incentive to create enormous wealth for you. And that's the idea of the VC compensation and carried interest. Now, there's a common descriptor of the specific numbers involved in this compensation, and it's called a 2 and 20 shop. And the 2% is 2% of the asset committed is paid to the VC firm in order to support its ongoing operations. It's a management fee. And if the fund is, say, a $500 million fund, which is not an unusual size fund, we have funds of that amount or sometimes even more. So 10% will be 50 million, 1% is 5 million, 2% is 10 million. So the agreement will state that the institutional investors will pay 2% or $10 million a year to help the VC firm run its business in terms of overhead and management. Now that's just covering bills, nicely I might add. However, what happens when we succeed? Well, that's when the 20 comes in. 20 is the amount of the excess over the amount returned to the investors, how much the VC firm gets. So a company, or I guess the collection of companies that provide $500 million to this fund, once they get back their $500 million, the excess will go 80-20. 80 to the investors and 20% to the VC firm. And now you see the tremendous leverage and profit potential for the VC firms if they do their work right. It's a risky business even for those who are expert. So it's not a certainty that VC firms will always succeed. But if they do, it's a very lucrative payday.